Hey everyone, Eric here. In this video, I'm going to teach you about contribution margins for e-commerce and how to calculate them. By the end of this lesson, you'll understand how to think about e-commerce profit margins and how to measure your marketing efficiency. Okay, let's get started. So in today's lesson, I'm going to cover some definitions around different types of profit margins for e-commerce. Then we are going to look at a simplified unit economics analysis for a real e-commerce business. And then we are going to go through a case study where we have reorganized the income statement to look at all the different margins of an e-commerce business, including gross profit, contribution margin, customer acquisition cost, and finally, operating income. So let's go to the top and start with some of our basic definitions. So contribution margin is the profit margin that we ultimately want to work back from when we are thinking about optimizing an e-commerce business. So the definition is the total profit generated after selling and delivering a product to a customer. This is the profit contributed to your company that you can then use for marketing and other operating expenses. So some of these ideas are used interchangeably. Often people say gross margin when they mean contribution margin and vice versa. So it's important to define them according to how you're running your business and then measure them as unique ideas. So the first type of margin is gross margin. And so the percent of revenue in this case will be the highest. And this is just the idea of how much profit you make at the product level. So you take your revenue and you basically subtract your product cost. Now, it's more nuanced than that, and we're about to jump in on this case study. But it's the idea that if you sell a product for, let's say, $100 and it costs you $20 to make it and get it to your warehouse, well, your gross margin is about 80%. Now, contribution margin takes it a step further. So in this case, the percentage is going to be a little bit lower than your gross margin. And this is how much profit you make after, of course, producing a product. But contribution margin also includes the fulfillment of the product. So delivering it to the customer's doorstep. So this is revenue minus product cost minus fulfillment. So your product cost and your fulfillment you look at as two separate ideas that they're both getting backed out of revenue, but you have the chance to evaluate each one independently. Finally, you have your post-marketing contribution margin. And so this will be the lowest, and this is the idea that after you've produced the product, delivered it to a customer, and spent all the money on marketing, did you actually make a profit? And so this is a very, very important contribution margin view of whether or not your business is generating profits. So now that we've got those definitions straightened out, I want to briefly review a summary level of the unit economics that we're about to dive into down below on how to calculate them. But before we dive into this, I want to say a huge thank you to the sponsor of this video, Bainbridge. They help e-commerce businesses with financial planning and analysis, and a big part of their solution is a cloud-connected financial model. They actually collaborated with me on this Excel template, which you can of course download for free in the description below. I work with them on a very successful e-commerce startup, and they connected all the data sources and built out a whole financial model that stays updated with live data, including tons of LTV and retention analysis, along with CAC and the other most important eComm metrics. They've allowed us to take a step back to focus more on the strategy of our business while they do the heavy lifting on the modeling side and surface metrics. So if you're an e-commerce business based on Shopify, you should consider booking a demo with Bainbridge to see how they can support you. They also created a special offer for my audience, so make sure you use the link in the description below to get access to it. Okay, so at a high level, here is how we would break down unit economics for an e-commerce business. So you have your net revenue, and we'll dive more into gross versus net revenue here in a moment. And then after that, you have what we are calling our COGS, which are just the product costs and any cost that it takes to get the product to the warehouse. From there, you have your gross profit margin, and then you break out separately your fulfillment cost. So that's getting the product to the customer from the warehouse. Here you can see you have your contribution margin. So we call this unit economics because these metrics are broken down per unit. So that's $64 of contribution margin per unit. That means that you basically have $64 to spend before you are break even on the product. So our next metric is CAC, which is your customer acquisition cost. And that is the average marketing cost that you invest to get one new customer to buy for the very first time. So we're saying that if we get a customer to buy, they generate $64 of contribution margin for us. We actually spend $42 on marketing to get them into the business. And so we have a profit. If you look at our contribution margin CM after CAC, even after spending money on marketing, we're profitable. We make $22 here, we make $12 here, and you can see the ratio of contribution margin to CAC on the first order is about 1.5. So we're profitable on the first order. If you're profitable on the first order, then all of the subsequent orders that a customer makes when they return will be pure profit because there'll generally be little or no marketing associated with them. So being profitable on the first order is ideal, and some businesses are very profitable on the first order, and those are exceptional e-commerce businesses. Okay, so let's jump into more of the detail around what does this stuff actually mean. And one thing I want to say is a typical P&L would have effectively all of the product costs and all the fulfillment costs in one giant bucket, which you would just call your COGS. But this is a more e-commerce oriented way of organizing the P&L, so you can see more specifically from a unit economics view what is moving. Is your freight per unit moving around? Are certain unit economics improving or getting worse? And the more you can get the visibility into each individual line item, the more you can optimize your business. So first you have your gross revenue. And so in this situation, in this case study, we're saying that product sales go in your gross revenue, and taxes collected go in your gross revenue. So you have gross revenue of 176,291, and here are the units sold: 1,236, 2,136. So we're effectively just looking at our gross revenue per unit, and here you can see it's 142 and 136. Next, you have the adjustments to your gross revenue, which get you from gross revenue to net revenue. So discounts are backed out of your gross revenue. Returns are backed out of your gross revenue. But shipping income, basically shipping charges that you charge per customer, depending on how far they are from the warehouse, which country they're in, etc., increases your gross revenue because that's not actually the product that you're selling, but it is a revenue generating item. So these two things are revenue decreasing, this is revenue increasing, and then you have your total net revenue, which is the sales you're actually collecting. So this is what we call your AOV, which is your average order value generally. So this is your net revenue. So now we basically see that we have $134, and we're trying to see, can we sell a product for $134, make the product, deliver it to the customer, do all the marketing, and have any profit left over? And that's the real core idea that we're trying to understand when we think about contribution margins. So first, let's go into COGS. So COGS, from an e-commerce perspective, would include product costs, so just making the product itself, import freight, so that's getting the product imported into the country wherever you have your warehouse, and import duties and taxes. So this is generally related to making the product and getting it to a place where it can be fulfilled. So we're saying that the COGS as a percentage of net revenue in this month are 29% of revenue, and this month they're 27% of revenue. So it's only costing us about $39, and in this month $35 to make the product and get it to where it can be fulfilled. So that leaves us with a healthy amount of gross margin, around 70 to 75%. But then we have the question of fulfillment. And fulfillment has a lot of different things, that can roll into it depending on, what type of product it is, where it needs to be fulfilled from, etc. So you have pick and pack in the warehouse, which is packing the orders basically. Then you have packing materials, and you can see that the unit economics of each of these things is changing. So the pick and pack went down. This month, maybe we were able to implement some kind of a better system that made it go faster. Packing materials, other third-party logistics charges, shipping to customer. So right now it is 2020, and freight costs have been varying, wildly all around the world. And so shipping has been a big thing that e-commerce businesses have been trying to manage. So you want to make sure that it's really called out. Any import freight, duties and taxes, shipping to customer. You want to make sure you are really, really focused on these items to understand which directions they're going. And then merchant fees, we say are $365 an order and $379 an order. So total fulfillment costs are $31 an order, $35 an order. And so your contribution margin after getting the product to the customer, in this month it's $79K, $128. So we made $64. We sold the product for $134 and getting it to the customer's front door was $64. And this month we made $60. So your contribution margin was a little under 50%. And then the biggest question mark now is marketing. So with $64, can we do enough marketing to even get one sale? So in marketing, there are going to be a number of different buckets. What we're trying to figure out is our customer acquisition cost, which is the average marketing cost to basically make a sale. So marketing could have many, many different things, but a typical business will have things like paid advertising. Maybe they're doing influencer partnerships where they're paying influencers to promote their products. Other marketing could be many different things, agencies. And so we're saying that all in, that this business basically spends between 31 and 36% of its revenue on marketing. And so the marketing cost per order this month is about 42, and this month it's about 48. And so your post-marketing contribution margin, or contribution margin post-marketing, in this month is $27,000. So it's only $22 an order. And then this month, it's only $12 an order. So we're still profitable, but you can see that between the product cost, the fulfillment, and the marketing, there's not a lot left over. And with whatever's left over after marketing, we need to pay our kind of recurring operating expenses. So we're saying that our operating expenses here are in this month around 10K, and this month around 13K. So we have a small team of a couple, 1 or 2 people, and we have software, we have a few consultants, other miscellaneous, and that is our entire OpEx. And so on a per unit basis, we are spending about $8 an order on OpEx, and then $6. The idea is that you're able to keep your OpEx relatively stable as you grow your revenue and your OpEx becomes a smaller percentage of your revenue. And so our operating income, which is basically your revenue minus everything, minus all your expenses, is about 11%, and here it's about 5%. And that means that we make about $15 per unit of profit and $6 per unit of profit. And so you can see that these e-commerce businesses, the key to success with these businesses is optimizing the unit economics. If you can negotiate or eliminate any individual expense and knock a couple dollars out, that might be the difference between an extra $5 per order, which multiplied over thousands and thousands of orders could be the difference between tens of thousands of dollars of losses or tens of thousands of dollars of profit. Okay, I hope this gives you some perspective on how to calculate and track contribution margin and other profit metrics for e-commerce. As always, in the description below, you can download this Excel template completely for free. And if you found this content valuable, please like and subscribe. Only 10% of my viewers subscribe. Thanks for watching, and I'll see you in the next video.